ARM holdings just dropped over 8% in a single session, wiping out billions in market cap. But here's the twist. This stock is still up nearly 180% this year. So is this the start of a real crash or the buying opportunity everyone's been waiting for? Let's break it down. Right now, ARM is trading at $260.01, down over $23 on the day. That puts its market cap at just over $301 billion. And here's the number that should stop you in your tracks. A price-to-earnings ratio of 334. This is not a cheap stock. So why the sell-off? There's no single bad headline here. This is a valuation unwind. ARM has surged roughly 179% since the start of 2026, and traders are locking in gains before a major event, earnings on July 29th. At 380 times earnings, even a small stumble can trigger a big reaction. Here's the pattern investors need to understand. Last quarter, ARM posted record revenue and beat every single estimate, and the stock still fell 7%. Why? Because demand for their new AI chips is outrunning what they can actually deliver. ARM has only secured supply chain capacity to cover the first $1 billion of a much bigger demand pipeline. That unsecured gap has triggered sharp drops before, even on good earnings. Now here's why bulls aren't running for the exits. Data center royalty revenue more than doubled year over year. ARM-based compute now holds roughly 50% share, with the biggest hyperscalers, Google, Amazon, and Microsoft are all shifting toward ARM-based chips. And technically, the stock is still 44% above its 200-day moving average. The long-term trend is still up. You've probably seen those wild price targets, a low of $125, a high of $500. But don't get distracted by the extremes. The actual Analyst average is around $275. And an independent fair value model from Simply Wall Street puts fair value at just $172. Well below even where the stock sits after this drop. That's a big gap between hype and hard numbers. Everything right now is just noise compared to what happens on July 29th. Wall Street expects 36 cents a share in earnings on $1.27 billion in revenue. The real question isn't the chart pattern. It's whether ARM can start closing that supply gap. That's what will actually move this stock, not premium and discount zones on a trading chart. So, buy the dip or stay away. This is a high multiple momentum stock deflating ahead of a binary earnings event. The fundamentals, hyperscaler adoption, doubling royalty revenue, are genuinely strong. But the valuation is priced for near perfect execution, and this stock has a track record of dropping even on good news. This is not financial advice. Do your own research and manage your risk going into July 29th. If you want the full breakdown the moment ARM reports earnings on July 29th, hit subscribe and turn on notifications. Drop a comment. Are you buying this dip or waiting it out? See you in the next video.